Welcome to ICAN Academy YouTube channel. In this video, I will examine IAS 36, impairment of assets, specifically impairment of an asset that have been revalued, using questions from ICAN May 2024 financial reporting. If you are coming across my lecture for the first time, please make sure you like the video, share it with others, and subscribe so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you for being part of this channel. Impairment loss is normally recognized immediately in profit or loss as an expense. We normally recognize impairment loss as an expense in the statement of profit or loss. However, an impairment of a previously revalued asset is recognized in other comprehensive income to the extent that it is covered by the revaluation surplus. Impairment loss not covered by a previously recognized revaluation surplus on the same asset is recognized in profit or loss as an expense. What does that mean? If an asset, maybe PPE has been revalued upwards by $100,000. So if PP is revalued upwards by upwards revaluation means a revaluation surplus of 100,000 will have been created. So if a revaluation surplus of 100,000 is created, that means you are going to credit the revaluation reserve with 100,000, and the debit entry will be in PP in order to increase the PP to the revalued amount. So an asset which shall be revalued upwards in the subsequent year now suffered an impairment loss. Let's assume it suffered an impairment loss of $130,000. Impairment of $130,000. The impairment it has suffered is even greater than the revaluation surplus previously created on that asset. In that case, you are going to treat this 100,000 as OCI first. You know, this one, you are having it as other comprehensive income. In that case, you debit the other comprehensive income. Debit revaluation surplus. Surplus with $100,000. In order to cancel out the 100,000 you have at the credit side of the revaluation surplus, you first of all cancel out that amount by debiting the revaluation surplus or revaluation reserve. Then you now debit, the impairment loss. Now you are still left with 30,000. If you have subtracted 100,000 from 130,000, then you'll be left with 30,000. The 30,000 will be debited to profit or loss as an expense. That is impairment expenses, impairment loss of $30,000. If you debit impairment loss with 30,000 plus 100,000, that will be amounted to 130,000. Then the total impairment now will be credited to PPE. You now credit PPE by 130,000. In order to reduce the PPE by the 130,000, the impairment it has suffered. The implication of that is that you will first of all cancel out the amount the PPE was previously revalued, the amount of revaluation surplus which was created when that PPE was revalued previously. First of all, eliminate that. Then the balance of the impairment loss is the amount you are going to charge as an expense in the statement of profit or loss, not the whole 130,000. The whole 130,000 should not be recorded as an expense in the profit or loss as impairment. First of all, eliminate the revaluation surplus, then the balance now is what we are going to charge as an expense in the statement of profit or loss. Now, let's take question as work example from ICAN May 2024 financial reporting. Keep watching. ICAN May 2024 financial reporting question number 4. A. Differentiate between impairment and depreciation. B. Discuss the following as contained in IAS 36, impairment of assets. 1. Indicators of impairments. 2. How to identify and account for impairment of assets. C. A non-current assets in the statement of financial position of Zamfara Limited, an SME, at the beginning of the financial year had a carrying amount of 800,000 naira. The asset had previously been revalued, and there was a revaluation surplus of 50,000 naira relating to it in the revaluation reserve. At the end of the financial year, Zamfara Limited suspected that the asset had been impaired. It therefore estimated the recoverable amount of the asset and found this to be 600,000 naira. The depreciation charge for the asset for the year will be 80,000 naira required. As the finance manager of Zamfara Limited explained with relevant computation, the accounting treatment required in line with the provision of IAS 36. Now, let's have solution to the question. Solution. In the A part of the question, you have to differentiate between impairment and depreciation. I know most of you might say depreciation is the reduction in the value of an asset due to wear and tear, passage of time, obsolescence, and etc. So don't give such definition in ICAN exam. No single mark will be awarded to you if you define depreciation as such. Therefore, how should depreciation be defined? Depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. Depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. Over its useful life. Systematic allocation of the depreciable amount of an asset over its useful life. That is depreciation. And when we say depreciable amount of an asset is the cost of the asset, or amount that can be substituted for cost, less residual value of the asset. Why do you charge depreciation in account? You charge depreciation in compliance with accruals or matching concept. And we equally charge it in line with prudency concept or the conversion of conservatism, which you find that profit in account should not be overstated. That you should always make adequate provision for foreseeable losses. So if you have profit, you understate it. That is prudency concept or the conversion of conservatism. You have to differentiate between impairment and depreciation. So when we say impairment loss, that is IAS 36. The objective of IAS 36, that is impairment of an asset, is to ensure that the assets are carried in the financial statements. The assets are carried in the financial statements at no more than their recoverable amount. That means the value at which an asset should be recognized in the financial statement should not be more than their recoverable amount. So in line with that, impairment loss in accordance with IAS 36, impairment loss is the amount by which the carrying amount of an asset exceeds its recoverable amount. The amount by which the carrying amount of an asset exceeds its recoverable amount. So where the carrying amount where is greater than the recoverable amount. The excess is the impairment loss. Impairment loss. So it means if the recoverable amount is greater than the carrying amount of an asset, such asset has not been impaired. B. Discuss the following as contained in IAS 36, impairment of assets. Number 1, indicators of impairment. We want to discuss the indicators. Indicators, B1. Indicators of impairment. We are going to categorize the indicators of impairment into 2. We have the internal indicators, internal, and the external indicators. So we are starting with the internal indicators. Internal indicators. By internal, we mean those within the firm, those within the entity. Number 1, there is an impairment if there is evidence of obsolescence or damage to the asset. There is what? There is evidence of obsolescence or damage to the asset. That is number 1. Number 2, if there is changes or if changes have occurred to the way the asset is used. Changes has occurred to the way asset is used. These are in the internal indicator for impairment. Number 3, if there is if evidence is available from internal reporting indicating that the economic performance of the asset will be worsened than expected. Evidence is available. Evidence is available from internal reporting. From internal reporting. Evidence available from internal reporting indicating the economic performance, indicating the economic performance of the asset will be worsened than expected. Will be worsened than expected. These are internal indicators. of impairment. Number 2, we have external indicators. External indicators. By external indicator, we mean those one outside the reporting entity. Number 1, the asset market value has declined more than expected. 1, the asset market value has declined more than expected. If the market value, the amount the asset can be obtainable in the market, if that value has fallen, that means the asset has been impaired. Number 2, changes in the technological market, economic or legal environment have had an adverse effect on the entity. Number 2, changes in the technological market, economic or legal environment have had an adverse effect on the entity. Adverse effect on the entity. That's number 2. Number 3, external indicator. Interest rates have increased. Just increasing the discount rate used in calculating the asset value in use. Interest rates have increased. Just increasing the discount rate used in calculating the value in use. These are the external indicators for impairment. 2, how to identify and account for impairment of assets. An entity must carry out an impairment review where there is evidence or an indication that impairment may have occurred. So an entity must carry out an impairment review when there is an evidence or indication that impairment may have occurred. If such indication exists, the entity must estimate the recoverable amount of the asset in order to establish whether the impairment has occurred or not. So if an impairment, that is, if the carrying amount of the asset, if the carrying amount is not greater than the recoverable amount, that means there is impairment. So in that case, the entity should immediately recognize impairment loss as an expense in the statement of profit or loss, and the value of the asset should equally be reduced. So that is the requirement 2. C, a non-current asset in the statement of financial position of Zamfara Limited. The name of the entity is Zamfara Limited. Now let's have C. Zamfara Limited. And SME at the beginning of the year. This transaction took place at the beginning of the year. At the beginning of the financial year, had a carrying amount of 800,000. So as at the beginning of the financial year, we have the carrying amount of 800,000. That is the carrying amount. We want to compare the carrying amount with the recoverable amount in order to know if this asset has been impaired or not. Back to the question. The asset had previously been revalued, and there was a revaluation surplus of 50,000 naira. We have revaluation surplus of 50,000 naira relating to it in the revaluation reserve. At the end of the financial year, so we are now particular about the end of the year now. The carrying amount of 800,000 was at the beginning of the year. So at the end of the financial year, Zamfara Limited suspected that the asset had been impaired. It therefore estimated the recoverable amount of the asset and found this to be 600,000. So this is the recoverable amount. We now have the recoverable amount to be 600,000. The depreciation charge for the year, for the asset for the year, will be 80,000. If the carrying amount of the asset at the beginning of the year, if it was 800,000, remember it was at the end of the year that the recoverable amount of the asset, end of the year, that the recoverable amount was measured to be 600,000. Therefore, the carrying amount, it will not be ideal you compare the carrying amount at the beginning with the carrying amount at the end, with the recoverable amount at the end. So you will need to determine the carrying amount at the end of the year so that it will be in line with the recoverable amount, the period of the recoverable amount. So how much is the depreciation for the year? 80,000. So if you now charge depreciation of 80,000, depreciation, this carrying amount was at the beginning, depreciation of 80,000. If you remove 80,000 depreciation, then you have carrying amount at the end. Carrying amount, the one at the end of the year. This is the one at the beginning of the year. That one is 800,000. So at the end of the year, the carry amount will be 720,000. If the carry amount at the end is 720,000, how much is the recoverable amount at the end? We were told at the end of the year, at the end of the financial year, Zamfara Limited suspected that the asset had been impaired. It therefore estimated the recoverable amount of the asset and found this to be 600,000. So this is the recoverable amount at the end of the year. So you have the recoverable amount, recoverable amount, and that amounted to 600,000. If you remove 600,000, the carrying amount is greater than the recoverable amount by 120,000. That 120,000 is the amount of the impairment loss on the asset. Impairment loss. Have that to be 120,000. So now, let's raise a journal entry for the accounting treatment of this. Journal entry. It's not necessary. It's not a must to have a journal entry for this. You have the impairment loss of 120,000. But this asset, which now suffers an impairment, has been revalued upwards by 50,000. And you are having 50,000 credited to the revaluation reserve. You have 50,000 credited to the revaluation reserve. You first of all cancel that 50,000 from the revaluation reserve since it has been credited there. So you debit revaluation reserve. So you debit revaluation reserve with 50,000. 50,000 you debited to revaluation reserve. We cancel the amount at the credit side of the revaluation reserve. So the remaining balance will be debited to profit, statement of profit or loss. Statement of profit or loss. So you have impairment loss of 120,000. 120,000 minus 50,000 credited to revaluation reserves. So you'll be left with 70,000. So it is the 70,000 you are going to record as an expenses in the statement of profit or loss. You are going to charge 70,000 as an expense. You will cancel out 50,000 from revaluation reserve. Why the asset will now be reduced by 120,000? You credit the asset account. And what is the asset? So you were told a non-current asset. You were told it's non-current asset. So you credit the non-current asset account. Non-current asset. So you credit it with 120,000, the total impairment loss suffered by this asset. This is the accounting treatment. So you are going to subtract 120,000 from the non-current asset. You charge 70,000 as an expenses, and 50,000 you eliminate it from the revaluation reserve. So this is the accounting entry, and that is the solution to the C part of the question. Please don't forget to like the video, share it with others, and subscribe. Drop the love emoji. Thanks for watching ICAN.